Hi, I'm Mark Hebner, President of Index Funds Advisors, and welcome to IFA.TV, where we replace speculation with an education. And today you're going to get a real special education because we have Weston Wellington with us here from Dimensional Fund Advisors. Weston's a vice president over there at Dimensional, and he's part of the in-house research team, and also probably one of the world's foremost educators on how capital markets work. Weston travels the world speaking to both individual clients as well as investment advisors, trying to give them a lot of lessons about how capital markets work. And one of those lessons is clearly spelled out in what's called the Dimensional Matrix book. And Weston's here today to talk about this book. Weston, welcome to IFA TV.
Great to be here, Mark.
All right.
Thank you.
Great to have you. So it's been 31 years that Dimensional has been publishing this Matrix book. These books have been labeled what are called client ready at Dimensional. What that means is we can discuss it and share with you some of the information that are in these wonderful books. And so, Weston, why don't you first talk about some of the lessons we can learn about capitalism and maybe capital markets from a book like what you guys have assembled here.
Okay, Mark. Well, if you open this book, it just looks like a forest of numbers. And so in one sense, it may look like a dull read that doesn't have much to tell us. But in a very real sense, this is a record of free market capitalism in both the U.S. and around the world, in a sense that investors are an important leg of the three-legged stool, so to speak, that supports a free market economy. We've got capital, we've got labor, we've got entrepreneurs, and each of them has an important role to play. Investors with capital supply capital to entrepreneurs who don't have capital but have ideas. And the capital markets are where those parties come together to strike a deal. Every business owner wants to get capital on the most favorable terms at the lowest cost. Every investor wants to rent out his or her capital, so to speak, contribute it, and get the highest return on their capital. And there's a negotiating process that goes on. And when a deal gets struck, transactions take place, companies get formed, they conduct their affairs. And the record in this book is essentially a record of what have the returns on capital been for these suppliers of capital. Now, you may wonder, if you look at the contents page, why there are so darn many various data series. Why isn't there one just big return on capital for the capital market? Well, it depends how we define the capital market. There is a basic return on all the stocks in the U.S. marketplace, and increasingly in markets all around the world. But academic researchers, one of their principal tasks is to understand what are the risks that investors supplying capital seem to get rewarded for, and how do we define and quantify those risks. And what the researchers have discovered through a lot of hard work covering the last 40 to 50 years is that risk seems to come in some varying flavors. Small companies appear to be riskier in some way than large companies, and as a result, the cost of capital is higher for small companies and the investor expected return is higher. Same is true for so-called value companies and so on. And so in this book we find a whole variety of data series, some of them going back as far as 80 years or so. What has the rate of return been for large companies or small companies, growth companies, value companies? A lot of this data is focused in the U.S. market, where we have some of the most extensive data series. But increasingly, as markets adopt this free market approach all around the world, we have data from other developed country stock markets and increasingly emerging country stock markets. And in every case, what we find is that, as a generalization, capital markets have rewarded investors for the capital that they supply. That doesn't imply it's a guarantee, but it's certainly our best expectation and consistent with how we believe the world works.
And Weston, the inverse of that is the cost of capital of these various types of companies, right? These
Right.
groups of companies.
Right.
You mentioned that briefly there, but I think that's another really important point, that as we look through these indexes, not only do we see the returns, but we see that the firms, or the people who, the shareholders of those firms, whoever they might be,
Right.
has a cost of capital that's equal to that return, right? I don't know if
just-
you want to elaborate on that, but
Well, I think a simple way of thinking about it is that the cost of capital and the investor's return are just opposite sides of the same coin.
that's right.
If I go as a company to borrow money for my enterprise, and if I'm a untested, risky enterprise, when I go to the bank officer for a loan, I'm not going to get a very low interest rate as a AAA, highly profitable company with a long history of doing business at the bank. I'm going to be charged a higher interest rate because I'm a riskier credit for the bank. That's appropriate. That's how markets work. Risk and return are related. If the bank, as a supplier of capital in the way of a loan, sees a higher risk, they're going to demand a higher expected return. Investors do the same thing in the equity markets. It's just a little harder to see because it's not a loan, it's an actual equity interest in the company, but the same principles apply. We think the equity markets work just the same way the loan market or the bond market works. Risk and return are related. Riskier securities have higher expected returns. That's how it should work in a fair system, and that's how the empirical evidence shows it has worked all around the world.
So Weston, if you'd indulge me for just a moment to dig into the forest here, but in page 9 of at least the 2013 edition of this book, there's a little explanation, but maybe you could kind of put it in your own words.
I'm going
you
to
might
flip
think
over
of it.
to the next page where
Perfect.
we have the S&P 500 index, so I can give you a specific example.
That would be great.
And those of you who are still fond of reading maps, as I am, may recall things like the Rand McNally Road Atlas, and you'd have a mileage chart. And you usually have to squint a little bit and figure out just exactly where Milwaukee or Chicago is on the grid there, but eventually you figure out and you connect the 2 points, and you can find out the mileage between those two cities. Well, these charts work just the same way. So if I start in 1975 for the sake of argument, and I want to quickly figure out with just my index finger as my only tool, what was my rate of return? If I started investing in 1975 and I ended up in 1994, no slide rule, no computer necessary, just your index finger and maybe a set of eyeglasses. And what this is helpful is to study the long run rates of return on capital markets. And we can see that for short holding periods, prices are very volatile and returns are volatile. And yet the longer we extend that period, the more these numbers tend to converge with a similar outcome. And it's a very helpful way of, if you want to spend a rainy afternoon getting a great education about the virtues of long-term investing, this might be a good place to start. Just pick numbers at random and imagine you were investing starting in 1942 when the World War was in full-blown rage and we were worried about German submarines off the coast of New England, and see what happened if you'd owned stocks for the next 10 or 20 years and how did it turn out. And pick other time periods where you may recall certain events and see if the subsequent performance over the next 5 or 10 or 20 years conforms to your intuition or perhaps not.
Yeah, so Weston, I just happened to notice 42 to 62 was about 15.5% on this chart. And I also think it's kind of interesting. Let's go back to 1929, and you can kind of run your finger down here and see how long it remained negative. It was 1942, and you were still minus 1% annualized for that entire period from 1929 to 1942. And so there's a lot of interesting information like that in these books. Here at IFA, we've been working on a little project trying to collect copies of the book, of these deep matrix books going all the way back to 1982. And we've got about half of them so far, and we're working on a project comparing them and talking about the really interesting write-ups in the beginning of each one and the interesting covers that have shown up from each edition, and there's something new every time. This is a particular interesting cover talking about world market capitalizations. This was the 2008 Matrix book cover. And so anyway, a lot of fascinating information for that rainy day, as you said, Weston. And I just want to thank you for coming on IFA TV and explaining this wonderful book to everybody.
Thank you, Mark.
Thanks, and we'll hope to see you again soon, Weston.
Great to be here.
And thanks for visiting us here on IFA TV. We'll see you next time.